Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Russian economy, and specifically to talk about what's going on with interest rates and inflation. Now, inflation is a key metric in any economy, and the reason that it is because it measures the movement in prices from one year to the next. And obviously, if inflation is rising at a rapid level, that puts pressure on people and companies within that country because they need to keep growing their own income just to keep at the same level of purchasing power. And then therefore it puts pressure on wages. People want to get paid more, and as they get paid more, they spend more, it drives up demand, and therefore it drives up inflation. So an economy can quickly find itself in a vicious upward circle where prices are rising, so are wages, people are spending more, and so it goes on. So as a way of trying to keep that under control, a central bank will increase interest rates. And we've talked about this thousands of times before on the channel. But the way that works is, the logic is, if you increase interest rates, it increases the cost of borrowing. Therefore, it discourages people from taking on new debt. It also increases the cost of existing debt, and it also increases savings rates. So people are encouraged to put more money in the bank rather than spending it. So the combination of all of those factors generally leads to a reduction in spending, therefore a reduction in demand, which brings prices back down. So that's the logic. That's why central banks increase interest rates at times when inflation is getting out of control. And in today's video, I want to talk about the fact that the Russian central bank has recently increased its interest rate to 18%. And the reason that it's doing that is because inflation is starting to get out of control in Russia. And an interest rate of 18% means that Russia now has the 15th highest rate out of any country in the world. And that tells us that there are fundamental problems in Russia right now. So in today's video, we'll go through the details as to what's been happening with interest rates, because they've been on the rise over the last 12 months. This time last year, interest rates in Russia were sitting at 7.5%, which means that they've gone up by 10.5% in the last year. We'll also have a look at what's happening with inflation and what's causing the increase in inflation. And this is a number of different factors, partly related to the sanctions that are being applied against Russia. We'll also have a look at what's happening with wages, because as well as the increase in wages as a result of the increase in inflation, there's also a workforce crisis going on right now in Russia, which is also driving up wages as a result of the fact that over 1 million people have fled the country, and also other people have been conscripted to go and fight in Ukraine. We'll have a look at what's going on with the Russian ruble, because usually there's a very close correlation between interest rates, inflation, and the strength of your currency. So we'll have a look at whether or not that correlation is showing through. And then finally today, I'll wrap up with my summary. So what I think the movement in interest rates and the increase in inflation means for the Russian economy, what this tells us about what's going on right now on the ground in Russia, and what's likely to happen over the course of the next 6 to 12 months. But before we get started on all of that, I'd like to say once again, thank you so much to everybody that's supporting the channel. So if you're a viewer of the channel, thank you. If you're a subscriber, really appreciate you signing up. It helps me with the numbers. If you're a long-term supporter, either through Patreon, where you can watch my videos early and advert-free, or YouTube membership, where you'll also get early access to my videos, or buy me a coffee membership, thank you for that long-term support. Really helps to keep me motivated. And if you've bought me a coffee or sent me a YouTube super thanks recently, thank you for the time and the effort and the generosity. I see all of those messages, so thank you for every single one of them. And if you'd like a fun and more interesting way to support the channel, why not buy a ticket in the prize draw for this, which is the Windswept Clock, one of the statues that's been featuring on my videos. This is an original piece by a British artist. It's a one-off. I don't have another one, so once it's gone, I won't have it anymore. It's actually got a fully working clock built into it, so you can actually tell the time with it as well if you're interested. But if you'd like to win this, have a look in the details below, and good luck in the draw. On Friday the 26th of July, the Russian central bank hiked its interest rate by 200 basis points to 18%, the highest level in more than 2 years. And Elvira Nabiullina, the governor of the Russian central bank, vowed to continue tightening the economy until inflation starts coming down. The bank also raised its inflation forecast for 2024 from the target level of 4% to 6.5 to 7%. And this chart shows the movement in the official interest rate in Russia over the past 3 years. And the scale on the right-hand side of this chart starts at 6% at the bottom and goes to 20% at the top. And what this shows is that this time last year, interest rates in Russia were sitting at 7.5%. And over the past 12 months, there have been 6 different interest rate increases totaling 10.5% to the current level of 18%. And if we expand the scale of this chart to show the position over the past 25 years, you can see that the current level of 18% has only been exceeded once in the past 25 years, and that was the emergency rate of 20% that was introduced on the 28th of February 2022, immediately following the invasion of Ukraine. And that rate was only in place for 40 days before it was reduced back down to 17%. So this really highlights the extreme problems that are going on in Russia right now, because we've got a rate that is almost equivalent to the emergency rate that was introduced by the Russian central bank following the start of the war. However, today's rate isn't an emergency rate. And as we've just discussed, Elvira Nabiulina has said that rates are likely to continue increasing until inflation is brought back under control. And if we compare the current interest rate of 18% with the rest of the countries in the G20, which are notionally the 20 largest economies, you can see that there are only 2 countries that have a higher interest rate. Turkey, where it's 50%, and Argentina, where it's 40%. And if you follow the channel, you'll know that we've talked about both of those countries a lot, and they are both in a state of economic crisis. The only other 2 countries that are in double figures in the G20 are Mexico and Brazil, and interest rates in both of those countries are considerably less than they are in Russia. And if we compare 18% against every other country in the world, there are only 14 countries that have interest rates that are higher. And when you look at the list of these countries, it really puts into perspective the severe problems in Russia, because the Russian economy is now rubbing shoulders with the likes of Pakistan, Angola, Zimbabwe, Liberia, Lebanon, Iran, Sierra Leone, Congo, Malawi, Nigeria, all of which are in a state of economic crisis. So this really tells us that there are fundamental problems in Russia right now. Now, as we discussed at the start of today's video, the main reason why a central bank will increase interest rates is to try to bring inflation back under control. And this chart shows the movement in Russian inflation over the past 12 months. And what this shows is that in June 2023, inflation was sitting at 3.3%. which was actually 0.7 below the Russian central bank's target level of 4%. So at that point in time, Russia was entirely happy with what was going on. In July, inflation rose to 4.3%, which is only 0.3% above its target level. So again, the Russian central bank at that point would have been very relaxed. And if you think about what was happening in the Russian economy back in July 2023, a lot of the sanctions were in place, and so you would have expected the full impact of those sanctions to have fed through to inflation. But what was going on with inflation at that point was very puzzling. If we widen the scale of this chart to show the position over the past 5 years, you can see that immediately following Russia's invasion of Ukraine, inflation increased from 9.2% in February to 16.7%, and then hit a peak of 17.8%. So what happened in March and April 2022 is not surprising. You would have expected inflation to start skyrocketing as a result of the fact that the sanctions were preventing things from being imported into Russia, and therefore Russia would have had to start paying higher prices to try and find alternative products. However, what happened in the 12-month period between April 22 and April 23 is quite puzzling, because inflation started to reduce and by February 2023 was down to 11%. However, in March 23 it reduced to 3.5% and then reduced further to 2.3% in April, which at that point gave Russia one of the lowest rates of inflation in the world. Now that is a remarkable achievement. Now if we quickly jump back and have a look at what happened to interest rates over that same period, between April 22 and April 23, interest rates actually reduced from 17% to 7.5%, which is slightly counterproductive because, as we've discussed, generally when you're talking about trying to reduce inflation, you increase interest rates because it discourages spending and therefore reduces prices. But Russia did the opposite. They were reducing their interest rates at a time when inflation was reducing rapidly. So this is why it is quite puzzling. And what makes it even more puzzling is what's happened over the past 12 months, because we've seen a rapid and consistent increase in inflation to the current level of 8.6%. And over that same period, interest rates have increased from 7.5 to 18%. So if you take a step back and have a look at what's been happening to inflation over the past 2.5 years, I think there's a question mark over the figures that were published between April 22 and April 23, as a result of the fact that we had reducing interest rates and reducing inflation. However, over the past 12 months, what we have seen is a rapid increase in inflation and also a rapid increase in interest rates. And these most recent results are far more logical as to what you would expect to be happening in the Russian economy. You would expect prices to be going up as a result of the sanctions and the workforce shortages. This chart shows the movement in food inflation in Russia over the past 12 months, and if you follow the channel, you'll know that this is a metric that I always like to look at because it gives us an indication as to the problems that are being encountered by the poorest members of society. And what this shows is that in June 2023, food prices were only increasing by 0.2%, which is very, very low. However, over the past 12 months, there's been a rapid and consistent increase in food prices. And the most recent figures reported for June 24 show that food prices are now increasing by 9.8%, which is 1.2% higher than general inflation. So food prices are rising at a rate that is higher than general prices, and that puts more pressure on the poorest members of society because they are spending a much higher percentage of their monthly income on food. And when prices are rising by almost 10%, they need to make sure that wages are also increasing by at least 10% in order to cover that increase. This chart shows the year-on-year movement in real wages in Russia over the past 12 months. And real wages are wages after taking into account the movements in inflation. So basically what that means is if there's a 2% increase in inflation, but your wages go up by 4%, then in real terms, your wages would have increased by 2% because it was 2% more than the level of inflation. And an important thing to note about this chart is that the scale on the right-hand side doesn't start at 0. It actually starts at 6% and goes up to 14%. And what this chart shows is that over the past 12 months, there has been a significant increase in real wages. And the most recent figures that have been reported for May 2024 show that real wages increased by 8.8%. So when you take into account the fact that inflation in May 24 was 8.3%, that means that the actual percentage increase in wages was more like 17%. So obviously that's good news for workers in Russia because they're now being paid more than the increase in inflation. So in real terms, people have more money in their pockets. But all of this is putting additional pressure on the Russian economy because what we've got is a situation where inflation is going up and so are wages. So let's have a look at what's happening with producer prices, as they give us a very good steer as to what's likely to happen to inflation over the course of the next 3 to 6 months. This chart shows the year-on-year movement in producer prices in Russia, which are also referred to as factory gate prices, as they're basically the price of products when they're leaving factories to go to the stores. And what this shows is that in June 2023, producer prices were flat. They were at 0%. However, over the past 12 months, there's been a rapid increase in producer prices. And the most recent figures for June 24 show that the producer price index increased by 14%. Which is almost 6% higher than the current rate of inflation. So what this tells us is that producer prices, the cost of things that are being made in Russia, that are then being sold to other companies or going to stores, are rising at a more rapid rate than general prices. And what that means is that future prices are likely to continue rising because when a company sells a product to a store or another company, it will want to sell it at a higher price. So a margin will be needed to be added to that. So it's likely, as we see an increase in producer prices, that general inflation will continue increasing. So what Russia needs to do is get to the point where the producer price index is actually below the current rate of inflation before general inflation is likely to start coming down because we've got a number of different factors that are pushing up inflation. Firstly, producer prices, the cost of producing things in Russia, which are then being sold to Russian consumers. But also, we've got import prices, so the cost of buying things in from other countries, which has gone up a lot over the past 2 years as a result of the sanctions, because Russia now has less choice in terms of where it's buying things, and less choice usually means higher prices. And also, we've got the impact of what's been happening with the ruble. This chart shows the exchange rate between the US dollar and the Russian ruble over the past 5 years. And the Russian ruble is something that I'm asked about all the time. A lot of people are obsessed with the value of the ruble because, generally speaking, the value of your currency does have a direct correlation to the strength of your economy. In usual circumstances, if your economy is doing well and other countries want to buy lots of products from you, then there will be demand for your currency. That will push up the value of your currency. It's simple demand and supply. When demand goes up, so does the price. And so as your economy improves, so does the value of your currency. And the opposite scenario also applies. If nobody wants to deal with you, if nobody wants to buy your currency, then the value of your currency usually falls. Now, what we can see from this chart is that in the period prior to the invasion of Ukraine, $1 was trading roughly for around 75 Russian rubles. However, immediately following the invasion, there was a collapse in the value of the ruble, and at one point it was trading for around 125 for $1. And the reason for that was because of the invasion. It was expected that sanctions would be applied against Russia, and therefore the level of trade that Russia was doing with the rest of the world would fall, and so would the value of the currency. However, there was an immediate bounce back as a result of the fact that the Russian central bank started buying rubles in the international market, to such an extent that the value increased to around 50 rubles to $1, which was actually the strongest level that the ruble had traded at any point on this chart. However, over the past 2 years or so, what we've seen is a deterioration in the value of the ruble, partly as a result of the fact that the Russian central bank stopped its policy of buying the ruble in the international market because it was becoming very expensive. But more importantly, there was a fall in the demand for the ruble because there was a loss of trade with the West. So a lot of countries that had previously been dealing with Russia no longer wanted to, and so no longer had any demand for rubles. But also the fact that the two new countries, China and India, that Russia was doing a lot of trade with, decided that they didn't want to do that trade in rubles. So China only wants to do trade in Chinese yuan, and India initially wanted to do trade in rupees. Russia said no, and so it's now doing trade in Chinese yuan and United Arab Emirates dirhams. So we've seen a reduction in the valuation of the ruble to the point where the ruble actually became worth 100 to $1. That was too far for President Putin. He then brought in a lot of controls, which forced Russian companies to use the ruble. And so that increased the demand for the ruble. And over the past 7 or 8 months, we've seen an improvement in the value of the ruble, and it's now trading at somewhere in the region of 85 to $1. But the problem that Russia has today is that the size of the market for the ruble is now very small because there are very few countries that want to deal in it. The only countries that are still dealing in rubles are countries that don't really have a choice, such as Venezuela and Cuba and other countries where Russia has the upper hand in their trading relationship. And so what this tells us is that although the value of the ruble has improved over the past 7 or 8 months slightly, it doesn't relate to the strength of the Russian economy because there is now a disconnect as a result of the fact that the market for the ruble is so small. The trade that Russia is doing internationally is not, generally speaking, being done in rubles. It's being done in other currency. So the link between the currency and the economy has been broken in Russia. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's going on with regards to inflation and interest rates is absolutely critical to telling us exactly what's happening in the Russian economy right now. Because, as you'll know, we've got very limited data. The Kremlin has reduced the amount of information it's prepared to share with the rest of the world, and actually that information is getting smaller and smaller on a monthly basis. I was previously providing a monthly update using the Kremlin's figures that it was posting on its Russian website. However, it's now cut off access to those figures, so we don't even see any of that data anymore. So really, the only things that we've got to go on right now are inflation, interest rates, and the strength of the ruble. Now, obviously, what we've talked about in today's video is that the Russian central bank has increased interest rates to 18%. That's an increase of 10.5% over the past 12 months. That is a very aggressive policy. If you look at what's been happening in countries like the USA and the UK over the past couple of years, there have been rapid increases in interest rates. However, those increases have been relatively small, and we've seen interest rates going from around 0.1% to around 5 or 5.5%. But what we've seen in Russia is a rapid increase from 7.5% to 18%. And unfortunately, from Russia's perspective, that doesn't look like the end of the game because inflation is still on the rise. And what this tells us is that there are massive problems happening in Russia right now. Now, as we've talked about in today's video, the factors that are driving up inflation are multiple. Firstly, Russia's got a whole raft of sanctions that have been applied against it over the past 18 to 24 months. And what that means is that imports are now limited. Russia can't buy all of the things that it was buying prior to the invasion of Ukraine. And so it's having to source things through different methods. Either it's now having to buy alternative products from countries like China and India, or it's buying things on the grey market, the black market. And where it's doing that, those products are costing significantly more. So the combination of those two factors has limited supply in Russia. And when you have limited supply, that always drives up prices. So that's pushing up inflation. That's raising the cost of things on the shelves in Russia. In addition to that, immediately following the invasion of Ukraine, we saw a crash in the value of the ruble. It fell from around 75 to $1 to around 120. And what that meant is that everything that Russia was importing suddenly rose in price because the ruble equivalent was a lot more expensive. So that pushed up prices. And the other factor that's pushing up inflation, and this is a major problem from Russia's point of view, is the workforce shortage. So over the past 12 months or so, Russia has converted itself into being a wartime economy. So a lot of companies in Russia have now been commandeered and are being told by the Kremlin that they need to produce things to keep the war effort in Ukraine going. And all of those companies are now being paid directly by the state. So from the company's point of view, that represents a very solid stream of income. They no longer have to go out and compete and fight with other companies to win business. They're being sponsored by the state. So that's great news from their income point of view. But what that's doing is driving up wages because the Kremlin is paying those companies a large amount. So they're able to hire more people. They need to bring in more staff to increase their productivity. But the companies that are losing people to those companies are now finding that they're having to offer higher wages to attract in replacement staff. And so we've got a wage spiral that's starting in Russia. And that's a major problem. And it's also being fueled by the fact that at the time of the invasion, around 500,000 people fled the country, and then a further 700,000 left at the time when the mobilization was announced. So 1.2 million people have disappeared from the workforce, and Russia is finding it very difficult to attract in migrants. So in the past, lots of people from the surrounding countries would travel into Russia and work there and send money back. However, because of the war in Ukraine and the risk of being called up for the army that these migrants are facing, that's reduced the inflow of workers. And so Russia now has a workforce shortage. So wages are on the rise, which is fueling inflation because as people are paid more, they're spending more, that's increasing demand, and so it goes on. So the fundamental problems that Russia is facing right now are very difficult to fix. Now, in today's video, we also had a look at what was going on with the ruble. And at face value, you might think that the ruble's doing quite well because the value has actually increased recently. And I get a lot of comments in the section below from people telling me that the ruble's doing well, therefore Russia's doing well, and I'm talking nonsense. But I think what we discussed today is that the market for the ruble is now very small. There are very few countries that want to deal in the ruble apart from Russia. And when you've got a very small market, it's much easier to control. And so the Russian central bank is now managing the ruble currency exchange rate. So basically, it's buying currency in the market to keep that rate exactly where it wants to. And the only reason that Russia can do that is because the size of the market has fallen dramatically. And as I've discussed in previous videos, I think the ruble is now dead as an international currency, and I don't think there is any hope now that the ruble would replace the dollar as the petrocurrency, which is what President Putin wanted to happen at the start of the war in Ukraine, because people are shying away from using it. So the overall summary of today's video is that interest rates have risen rapidly in Russia over the past 12 months. That rapid increase in interest rates has been brought on by a rapid increase in inflation. Inflation is being pushed up because of the shortage of products as a result of the sanctions, and also the shortage of people, which is causing a wage spiral in Russia. And all of these factors are putting further pressure on Russia and its economy and its reserves. And we talked about reserves in many other videos, but Russia is essentially funding the shortfall in its economy right now with its reserves. Those reserves have halved since the start of the war in Ukraine, and I've prepared a much longer video on this topic, which you can check out coming out very, very soon. The reason for the increase in inflation, interest rates and wages in Russia over the past 12 to 18 months are the fundamental problems in the Russian economy, which are unlikely to be solved at any point in the next 6 to 12 months. And so we're going to see further pressure applied to the Russian economy. It's likely that we'll see inflation and interest rates and wages continuing to spiral, and all of this is putting further pressure on Russian reserves, which at some point will run out if Russia continues to have to fund its losses. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Don't forget, you can win this by buying a ticket in the draw. If you're interested, have a look in the section below. And here's something to put a smile on your face.